Let me ask you this, have you ever bought a stock because everyone was talking about it, or sold too quickly because you were afraid of losing more money? If so, don't worry, you're not alone. In today's video, we'll cover the 3 most common emotional mistakes every investor makes: fear, greed, and FOMO, the fear of missing out. And more importantly, I'll show you real-life examples and tools that you can use to avoid falling into these traps. Mistake number 1, fear. Fear is the most powerful emotion in the stock market. When prices fall sharply, fear pushes investors to panic sell. Think back to March 2020 when the COVID-19 pandemic crashed the markets. The S&P 500 dropped more than 30% in just a few weeks. Many people sold at the bottom because they were afraid it would keep falling. But what happened next? Within months, the market recovered and then reached new all-time highs. Fear made people lock in losses instead of waiting for recovery. So how can you track fear in the market today? One useful tool is the CBOE Volatility Index, the VIX. When the VIX is high, it means fear is dominating. Another is the CNN Fear and Greed Index. This simple indicator combines market data like volatility, junk bond demand, and stock price momentum into a single score from 0 to 100. Below 25 usually signals extreme fear. You can check it anytime online. Mistake number 2, greed. On the other side, greed can be just as dangerous. Greed pushes people to chase unrealistic returns or hold risky positions for too long. A perfect example is the dot-com bubble in the late 1990s. Investors were pouring money into internet companies with no profits, only hype. Stock prices soared until they eventually collapsed. More recently, think about meme stocks like GameStop or AMC in 2021. People bought shares not because the companies were financially strong, but because they wanted quick profits. Some made money, but many others bought near the top and lost huge amounts when prices came back down. Greed blinds investors to fundamentals. Instead of asking, is this company profitable? Is this ETF solid? When they just ask, how much can I make right now? To avoid this, one simple practice is setting clear targets. For example, I'll take profit when this stock goes up 20%. Without a plan, greed will always tell you to hold for more until it's too late. Mistake number 3, FOMO, fear of missing out. Finally, there's FOMO, the fear of missing out. This happens when you see everyone else making money and you jump in late just because you don't want to be left behind. A real-life example is Bitcoin. In late 2017, when Bitcoin first hit $20,000, millions of people rushed to buy it. Within months, the price crashed by more than 60%. The same thing repeated in 2021, when Bitcoin went above $60,000 and then fell sharply. FOMO is powerful because it combines fear and greed together. You're afraid of missing the opportunity and greedy for quick profits at the same time. To manage FOMO, one strategy is to follow a dollar cost averaging plan, investing a fixed amount regularly, regardless of price. That way you don't feel pressured to buy only when markets are hot. This video is for educational purposes only and not financial advice. If you found it helpful, make sure to subscribe for more simple investing lessons.